Rothschild. Nothing I say is investment advice, and I have no intention to replace any content of security analysis, but to open it for discussion. This is chapter 51. Sorry. Yes, 51, which continues chapter 50, Discrepancies between price and value. He mentions at the beginning of this chapter, the last chapter was more focused on leading and secondary issues. This chapter brings up seasoned versus unseasoned issues. And so we have a whole discussion on basically how long a company's been around for and the kind of opportunities that lie within understanding seasoned issues and unseasoned issues. And so seasoned issues, including companies that have been around for a long time. Maybe they've never been public and now they're issuing new shares. So you can still have like new shares of a company that has been seasoned, that has proven to be able to generate income and stay safe for a long period of time before their IPO. And so the first main point coming out of this is that unseasoned securities naturally, obviously, have a higher beta. You know, he says it in more words. I just call it beta. If you don't know what beta is, look it up. It just means that if the market goes up 1%, if your beta is 1, your security goes up by 1%. If your beta is 2, when the market goes up 1%, yours goes up by 2%, and so on. That's what beta is. So obviously, he goes through the logic of this. It's pretty self-explanatory, but you know, one of the reasons for the higher beta of unseasoned securities is that they have more long-term holders that are less willing to sell what they have. Even when things are looking bad, they're less likely to get rid of it, whereas something that's unseasoned is obviously going to be like, oh, should I really have this or not, you know? And he goes through an example of seasoned company of some higher risk preferred shares selling at a premium, which he found to be, he kind of writes like, that's a ridiculous situation. And then he goes through what was going on. So in 1928, it was selling at 108. And so that's a significant premium, first of all. But during that year, they suffered an enormous loss, and the price went down in 1929 to 92.5. And so not much of a discount for a company that is obviously having problems with being able to pay its preferred shares. And then by the time it was 1932, the price had gone all the way down to three and an eighth. So I guess that's $3.16.5, I guess, for the price of those preferred shares, because it looked, I guess by that point it looked like they were never going to be paying anything. So anyway, the whole point of this example is that, you know, just because a company has been around a long time, if there are major problems, you know, and you're a holder of something like this, you know, just because it's seasoned, it doesn't mean that it necessarily will be, that it has so much safety. It doesn't have automatic safety, I think, is kind of the point that we can derive from that. So then we have a point made that railroads and public utilities are often unaffected by whether they're seasoned or not, just because of the traditional stability that those industries had, the reputation they had. You know, they were seen as very things that were never going to go away, basically. And so therefore, it does affect industrials. And he says, you know, basically avoid new industrial bonds or preferred shares for investment, especially partly because of the fact that unseasoned securities of this nature in a downturn, in a recession, in a depression, the prices will tend to drop further than that of more seasoned issues. And so, you got to be prepared for that. So then this he gets a little wishy-washy in my opinion here, where he says, well, should you buy it in that case if it's cheap? And he says, well, no, because seasoned issues, have reason for being seasoned because they survived longer. And so then we're talking about being seasoned is generally better. And then we have a point he basically is concluding that unseasoned securities are basically speculative and to only buy them on discount. And then the 70 to 100 being the normal price, so 30% up to a 30% discount up to zero discount is like a normal range for um, buying investable securities. But when it comes to unseasoned securities, you really should only be buying them at a more obvious discount. So I'm assuming he means below 70, so greater than a 30% discount at the very least. I mean, some of these discounts are like 95%, and you'll see in some of the you can see in some of the examples he puts up. So then, as with everything that he mentions, there are some exceptions, but not for preferred shares. Then we have an example of a good exchange. I find it funny because he talked about he can't. Earlier on we were talking about how exchanging one security for another is just generally a bad idea unless you're going to get 50% greater return. But then he has an example of of finding a scenario where it's actually like that, where you could exchange some a steel company bonds for bank bonds, like the corporate bonds of a bank, having plenty of safety and almost double the yield. So being a good deal, a good time to be, if you have a client, I guess, that has bonds, being like, yeah, switch over to these bonds. They pay a lot more, and it's actually, I think it was more safe. And again, obviously, part of the pricing differences is going to be between industries. I'm surprised he pulled that up, comparing a steel company to a bank, but we move on. So then we have an example of preferred shares being a good deal, but not cheap enough, because basically preferred shares are trash. Like he said a million times. It's funny how you can just think through his brain where he's like, oh, well, preferred share, this could be okay, this could work out, and then but they're generally trash no matter what. I find the dichotomy in his own brain going on. You can hear him thinking. Then we have a section on comparing definitely related issues, and this is just reminded. This is a little bit of a different subject, but it reminds me of the risk of junior bonds of the same company, having the same risk and a higher coupon rate, at least for investment. How that was one of the very earlier chapters. It just reminds me of that whole subject. But moving on, he mentions convertible arbitration if the stock price is too high, or from my perspective, if the bond price is too low. So if you have a stock price is way too high, obviously apparently there's arbitration plays that could be made, at least in that time. I don't know if these kinds of things are regularly available today, again, like we were talking about in the last chapter. And then he here, and then I remember just recently in one of the more previous chapters, he talks about hedging operations. I think when he says hedging, he's talking more about arbitration plays, taking advantage. But, more so, I think it was a situation where you could win no matter what, but he doesn't go into detail with that very much. So we're just going to move on anyway. So then we have an example of two companies owning the same road, where the value of the security was there was a discrepancy, and so um, there was a way to take advantage of that or switch one for the other, I guess. Then we have an example of overpriced preferred shares. I guess that's another example of it, like the last one. And then we have an example of stock price too high considering its cumulative preferred shares severely discounted. And, in this situation, this is obviously like a big market inefficiency. So if you have the stock price that's still way too high, but the preferred shares are at a severe discount, well, that doesn't really make any sense. And he suggests, like, if you want to speculate on this company doing well, the obvious correct play here is to buy the discounted preferred shares over, obviously much over than buying the common stock, because if the common stock is way overvalued, then you're going to get that automatic capital return on the preferred shares if things get greener. And then we have a section on discrepancies due to special supply demand factors. And he does not mention Treasury securities a whole lot in this book, but this is one spot where there was an interesting situation he references of when post-war Liberty bonds were selling at a discount to corporate bonds. And so, government bonds being the most secure and liquid out there, along with tax advantages, having a higher yield than corporate bonds, that was obviously a silly situation. And if you were owning corporate bonds at that time, it would be very obvious that it would be smart for you to be selling your corporate bonds in the market and buying the Liberty bonds. But I guess at that time, nobody wanted them. Everyone was liquidating them because the war was over, and I don't know. So it sounded like a weird situation. And then another example of when U.S. savings bonds, he says, were recently better than some corporate bonds, like higher yield. Again, having the tax advantage and extreme liquidity. No matter how bad the markets get or how bad things are, you could still turn in your bond for the principal at any time. It says so for those bonds. And so that was like a very obvious inefficiency going on. And it reminds me a little bit of, what's going on today with how I guess there's some corporations that actually have higher credit ratings than the United States. And there is a little bit of credence to that just because apparently the U.S. government can end up in a situation where they are defaulting on their debt. They're not paying the Treasury bond yields. They're not paying their coupons, or rather they're holding off paying for like a week or two. And, that's the equivalent, even though you're going to get your money for it, that is a default. And, it matters to certain institutional investors, especially, that need that payment. That 2-week period really does matter. And so that's how you can actually have corporate bonds that are more valuable than Treasury bonds. But that is chapter 51. Hope you enjoyed. Rob's Child.